Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Monday, April 5th, 2021. Well, it's a rally. I think you would be crazy to expect anything other than a rally this morning, at least if you were paying attention like I was on Friday while the markets were closed to the release of the latest employment numbers. That was a very unusual circumstance, not unprecedented. I do recall at least one other time, but I don't have it in front of me, when they released numbers when the markets were closed. Good Friday is a strange holiday in the U.S. because it's I think the only one where it's a market holiday but not a public holiday. So the government was open. The rest of the world was open. Quite frankly, I kind of like it because, we get a day off when the rest of the world is working, as opposed to, let's say, Columbus Day, which was apparently a market holiday ages ago. But where we're working and most of the country is not. Anyway, but I digress. Bottom line is those employment numbers were good, shockingly good. What they're reminding me of now is, I guess, what we went through in terms of earnings a couple of earnings cycles ago, where just every earnings release seemingly beat the number. And I think this is the tendency among analysts and economists to be somewhat conservative. Supposedly, there was a whisper number. But by the way, in case you weren't paying attention, it was the number was about 910,000 new payrolls versus an expectation that's about 660,000. But the interesting part to me was there was supposedly a whisper number of 800,000 in terms of payrolls. I hate the term whisper number. It reminds me of like the worst elements of the the 90s tech or bubble, where there was the published estimates and there was a whisper number. Cisco is the published number is $1 this quarter, but the whisper is $1.12. Then, if you're an analyst, then publish it $1.12. Come on, that's just silly to me. Regardless of that, I don't know how much credence to put in it. What we're seeing today, I guess, is to be expected. What we're seeing in the U.S. is employment recover faster than expected. We're not seeing a truly negative reaction from the bond market. And I think that's the key to the rally today. I think you would have to be kind of crazy to think that the economy was not on an uptrend as things reopen. We can debate the pace, but bottom line is things are reopening. More and more of the public is getting vaccinated. I've heard today 18% of the U.S. population is now fully vaccinated. Personal note, I will be joining these ranks pretty much as soon as I send off this video today. That I will tell you, psychologically, it's a big thing. I'm 2 weeks out, really, from looking at life, from being able to live life in a way that I did about a year ago, and that's meaningful. And I think when that starts to permeate people's mindset, that's a good thing. Now, I think the break, the governor, when I say break, B-R-A-K-E, the thing that tempers the economic enthusiasm would be the reaction of the bond market. I think if we saw the 10-year, instead of sort of tweaking up to about 173 or so where we are now, I think if that really broke through 175 and went higher in terms of yield, lower price, I think that would spook people. I think if we really saw the 2-year yield start to rise dramatically, meaning that people are beginning to really price in a Fed rate hike in earnest sometime in the next 2 years. The fact that it's around 18 basis points is telling you that there's some likelihood among investors that the Fed might raise rates sometime in the next 2 years. I guess that's not so far off from their guidance. I think if people start to doubt the Fed's resolve not to raise rates, you'd see that go up. We've seen the 5-year go up to around 0.97, 1% area. I think if we start to see breaks higher in terms of interest rates, the now BREAKS, the joys of English. If we start to see those rates move higher, I think that would give a bit more pause to the equity markets, because I think there'd be some thought to the idea that the easy money train might be coming to a halt. But as of now, you have all the elements of a robust market, if not a euphoric one. A strengthening economy. The effects of fiscal stimulus are still working their way through the system. You don't have the looming problem in April, mid-month, which is taxes. Those have been pushed back to May, which I'd raised the issue in a couple of pieces. That I do think that taxes are going to be a nasty surprise for a lot of new investors who were successful in 2020, but now are going to have to pay a lot of the bills in 2021. So actually, I think you have a very favorable seasonal time in April. It's typically a good month for the market. That's typically when people look at their IRAs and say, "Oh, I got to get that thing funded by April 15th." And so you've typically seen inflows, and then you start to see a little bit of decline afterwards. This year, that whole seasonal pattern is thrown off. It was completely thrown off last year, but I think this year it's going to be thrown off a bit. But as of now, you're in a good seasonal pattern. As I say, the one thing that really upends the cart in the short term would be a rise in bond yields, and I don't preclude such a thing, but it's not here today. And later in the month, we have to start thinking about earnings season. And you're going to have easy comparisons probably versus a quarter ago, but COVID really hadn't hit first quarter last year. So it's going to be interesting to see how the market takes that. That's a few weeks off, though. I mean, we're a couple weeks away from getting into earnings season in depth. So quite frankly, I think it's up to the stock market. Up to the bond market, and the stock market will take its lead, and it seems to be in a pretty good mood until or unless something external tells us otherwise. Have a good day, everybody. Bye-bye.